Hey there, guys. My name is Andrew Taranta, and I am going to be going over a very interesting investing strategy today. So, I wanted to kind of take a step away from the TRXC videos for a brief moment, and I kind of want to mix up the channel a little bit. And I thought it would be a really good idea to explain to you how I value invest and what value investing is so that you can walk forward with it and kind of get a good sense of what exactly value investing is. And I think it's very important to know what value investing is. I think it's one of the most one of the best trading strategies out there in my opinion. Just because it's when I go into it, you're gonna really start seeing how exactly it works and what exactly it does. And I guess you can kind of make the judgment call, but my personal opinion is it's one of my favorite ways to invest and really the only way I invest. I don't do any other types. When I talk about money making, I think real estate is really good. I think you could also even consider, I mean, at this rate, you might as well start really considering some these cryptocurrencies, which don't seem to be going away. But when it comes to, I don't do gambling if you can avoid it. No sports betting. It's quick money, but it's a quick way to lose money too. And there's no reason to have to make money that fast. I mean, yes, there's reasons to have to make money that fast, but it's not in the long run you're gonna lose. It's not gonna work out for you. But who knows? You know, I mean, I know some people make a killing, but I think you should probably do something where you have a lot more control. And value investing is really has allowed me to gain control over my investments, and that's what I really love about it. And make me a ton of money because I could find some really good companies to be dealing with. So I thought it was really sick. So ultimately, let's just hop right into it with what is value investing. So right here, I have a quote by Warren Buffett, and I'll just kind of draw a line. There you go. Right here, I have a quote by Warren Buffett, because I'm talking about it's the one that's highlighted. And it says, we're trying to buy, and the main question here, the first question I want to go over in this, and this is going to be a multiple part series, so don't think that this is going to be a one and done. So, what Warren Buffett is saying in this quote, and he and you can kind of get a good idea as to what what investing is going to be like when we read this quote. He says, "We're trying to buy $10 bills with $5 bills." Now, that's remarkable. That's a remarkable quote right there, because that's really what we want to do. We want to be able to find a $5 bill, or we want to find a $10 bill and only have to pay $5 for it. Make 100% return, right? Because the fact is, you're saying, well, Warren, you know, I mean, you can't, you know, everything's an even exchange. You know, if I want $10 in the world, I'm gonna need $10. And that's where the flaw is in the thinking. And that's what we want to remember. That's where the flaw is with the thinking, is that when we exchange money, right? If I give you $5, you have to give me 5 singles. If I give you 2 5s, you got to give me 1 10. There's a very even exchange rate when it comes to currency. And people make the false equivalency to the even exchange rates that they've kind of just experienced when it comes to money into the stock market, saying, oh, okay, if this is the price, then this is what it's worth. If this is the price, then this is what it's worth. And the yada, 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 yada. Not the case. Not the case. Because there are two primary things that will impact the ability for that to be the case. And those two things are fear and greed. And you know what? As a matter of fact, I'm going to change the color from fear just so you guys can get a good understanding to red. Fear. Okay? So we have our fear, and then on top of that, the other thing that always impacts the stock market is going to be greed. We're going to make this green. Oops, green. There we go. Greed. So we have fear and we have greed, right? Now, what fear does, fear is going to create this world where things are incredibly oversold. And a fearful thing is when an investor sells a stock because they're afraid that the stock is going to go lower. Because they think somebody else is afraid, and so then they'll think someone else is afraid, and they'll think someone else is afraid, and all of a sudden you think everyone's afraid, and now everybody becomes afraid, and then they start selling, and it becomes a self-fulfilling fear. And sometimes it's warranted. Sometimes when a company goes down, there's a reason to have a little bit of fear. But in that fear, there's usually the human aspect of it, where it doesn't measure itself properly. Sometimes the fear is so great that it creates companies that are so insanely undervalued, because maybe a small event happened. Like, let's say, for instance, this is a good one. I got this off of Phil Town's investing podcast, Invested, and I'm going to put a link in the description for it. Excellent value investing podcast. He goes and says, Gildan t-shirts, right? So Gildan t-shirts, t-shirt company, they had a little bit of a cotton situation. There was a cotton situation going on in the world, and essentially cotton prices were all out of whack. Margins were screwed up. Cotton became a lot more expensive. So t-shirt company suffered. And the CEO knew that. So he said, hey, listen, in a year, we'll be all right. But right now, it's not looking too good. We're not going to be able to make the profits we want to make this year because we just simply can't afford it, or whatever the case may be. It's just too high. We know they'll come down, but right now it's not going to work. Now, what's important about that and what's interesting about that is the stock plummets. As if this company, the value of the company is directly impacted in the long term based on a very short-term problem. So the fear you want to be looking at is you want to find, and obviously once the cotton prices got back to where they were, they exploded forward and they did fantastic. Or you can even look at Chipotle with the E. coli. You could see where it had some E. coli, and everyone was like, I can't, Chipotle, that's awful, so afraid. And then boom, popped up. Because eventually that fear, it's like that fear, what fear is? It's a lot like the first day of school, At first, it's the worst thing you could ever imagine, and then, like, last day of high school, you're just ready to get the heck out. It's like all this fear, all this anxiety, it does take time to get rid of that fear, right? So when you're value investing, you want to find companies that are either currently in fear or have been in fear for a little bit. You don't want to find a company that's just now tanking. Don't go to a company that just went down 20%, because guess what? That might go down another 20%, or not just down 20%, but a company that is on a bearish cycle. Don't just say, oh, it's in a downward trend, let me buy now. No, it's like, okay, how long has it been there? There's going to be a bunch of other factors you could see on the left here that are going to go into like which companies to choose. I guess we'll go right into that. But before I do that, I want to talk about this other thing, which is greed, okay? So greed essentially allows us to see that a stock price is going to continue to rise for no real reason. Same way that a stock price will drop for no real reason, or it'll go so far below the actual reasonable price or anything that would be kind of logical from a number standpoint. Greed will do the same thing. Greed will make people buy the shares of a stock because they know that they can make money. And when they see, basically when somebody sees this dude who's really stupid making a shit ton of money in the stock market, or their friend or whomever, and they say, hey, yeah, man, I've been making a crap ton of money. I don't know what you're doing wrong, and maybe you're smart, maybe you're really educated, but you keep messing up or you keep doing the wrong thing. And Now you're seeing this guy making a crap ton of money. You're saying, well, dang, I'll get in on that. And then another person sees that and they're like, dang, I'll get in on that. And then that creates a culture of greed where no longer are we kind of like looking to buy the company because we think it's such a great value investment. We're just buying a company because we're thinking somebody else will pay more for it. And sometimes that works out. You can look at Tesla, huge greed. It's so hard for me to want to buy Tesla just because it's so overly priced. It's so huge. And I think that's crazy. I think that's absolutely insane. So, I mean, obviously, a lot of people who probably are listening to this have Tesla stock, and it's not that I don't think it's going to go up. I just know that there's a lot of greed involved in that company, and I prefer to buy into fear because fear will turn into greed, right? Because if I buy into fear and I buy into a long fear and it checks off this list that I have here, then I know I'm in a much better position than if I had, let's say, decided, okay, let me buy, let me go into the greed, which I know will inevitably turn into fear for one reason or another. I mean, obviously, yes, there are very long bull runs, and in the long term, we can see, the stock might still just go up, which is another reason to not try to swing trade. But, it's still also a little safer too, just for yourself to always buy in the fear as well, because chances are if it does go back up and you bought at a certain number, you're not really panicking if it goes down because chances are it's probably not going to go as low as you bought it at, or it's probably not going to go at your bottom, which I think is really important. So that's another thing. So that actually brings me into the first point, which is buying a company with a margin of safety. And I highlighted on sale. And how do we figure out what a margin of safety is? So I'm just going to go over this point kind of briefly, and then I'm going to do another video where I explain it in depth. But essentially, a margin of safety is saying I'm going to buy this company at a price that I know is at least half of its private equity value. So private equity always sells, so public equity always sells at least 2 times as much as private equity. So you want to find a company, figure out what its total equity is, what you would buy it on a 10 years. Like if I were to buy a company and for, let's say, about I want to buy, a company that's making $1 million every single year, because that's what you're doing when you're buying a stock. You're buying a company. So think about it like that. Think about every stock you sit down and you consider buying. Ask yourself, would I buy this whole company for this current price? Right? Like, do I think this is worth the current price I'm paying for it? Now, if that's the case, then fantastic, buy the stock. But essentially what we're looking to do here is we're trying to figure out how do we know it's on sale. So let's say we have a company, right, that has, they make about $1 million a year, right? And, you could probably sell a company like that for about, let's say, 10 million, right? So in 10 years, now you're making money on the company. And that would be like a private equity sell. But in the public market, chances are when you're buying a company that's making $1 million a year, you're probably going to pay $20 million because it's in the public market. Now, what you want to find is the companies that are making $1 million a year, right, but are selling for only $5 million. Those are the companies you want to invest in, because now you're in a position where even if that company doesn't work out, first of all, you're in a much better position to get your money back because it only takes you 5 years to get your money back instead of the 10. And even if it does take 10, like the other scenario, nothing would be different because you bought it at a better price. So it gives you a margin of safety. And to kind of briefly go over that, it involves 2 numbers that you're going to want to know. And I'm going to put them just right under here. And that's your book value per share. Let's say book value, outstanding shares, and price over book. And let's do one of these. Okay. All right. Let's actually move this guy. Alrighty. So actually, let's make this guy a little smaller. Yeah, that's fine. Okay, so what you're gonna want here is you're gonna want to have your book value, okay? You're gonna want to have your outstanding shares, all right? Now your book value, essentially, just so you know, that's gonna be basically the total equity of your company. That's it. Just the total equity. That's it. That's assets. And how do I find the total equity? These are all going to be so easy to find, by the way, on Webull. But if you want, you can always just figure out what total equity is by subtracting the liabilities from its assets. A company's liabilities by its assets, and you can get a good idea what the total equity is. Then you want to know how many shares they have. Once again, that's very easy to find on Webull. And then you also want to know this ratio. This is a ratio, price divided by book. And you want to know exactly what the price is divided by its current book value. And then these two here, they basically come together to form a book value per share. So when you can divide the book value by the outstanding shares, the total equity, by how many shares there are, you'll get the book value per share, which would mean, let's say, now I don't love this example, but let's just say I had a company with, it's just such an ugly drawing that I did here, but let's say you have this pizza, right, for about here I'm going to circle where I'm at so you can see. So let's say you have this pizza here, right? So you have this pizza, and essentially what you're looking at is a company that has 1, 2, 3, 4, 5, 6, 7, 8 shares. So let me just do a different page just because I'm not too crazy about that. So if I have a company that has 8 shares, right, and each share is $1, okay, then my book value per share, okay, so it has it has 8 shares and each price is for $1, then essentially we would say that this company should be worth $8. But now, let's say the company has 8 shares, right? This is just the price. So this right here, this is just the price on the market. Okay? So that's just the market price. Now, so that's just what the stock market is saying. So let's highlight that as green. So this is the stock market. Actually, let's put that as yellow, I think. Yeah, let's do yellow. Just so we know what this is. Text. Stock market. And then let's do green, just so you guys can get a good understanding of what I'm doing here. And let's do green for, and then let's say it's really, let's say the company is worth, it has 8 shares, but let's say the company has an equity of about, so we'll just put X here actually. But we know the company is worth $16. And now we have to solve for X. So what we could do here is we can put a green for this, or, whoops, there we go. And then what we're going to do here is we're going to put, this is book value. I think this is a really good representation, just so you guys can get a good idea as to exactly what I'm referring to here. So I have $8, okay, in the stock market, and it's trading at $1 in the stock market. And so the company right now to the stock market is worth $8. And I'm going to do another highlight just so you guys can get a good idea as to what I'm referring to. And then now we have this $8 and this X, and that equals about $16. And this $16 is going to be the total equity of the company, right? So this is the total equity of the company, and we'll do one more just so you guys can get a good idea as to what I'm doing here. And let's just put. And remember, our total equity is represented by our assets subtracted by our liabilities. So if we know the total equity of the company is 16, right, and we know that it has 8 outstanding shares, then the true price, or X, should essentially equal X equals 2. So the book value should equal 2. But it's trading at 1, which leaves it with a PB ratio of 0.5, which means that this company is selling for half of its worth. And PB, remember, wonder if I put it in the price over book. Well, I didn't go over exactly what it was, but it essentially is essentially it's the price of the company over its book value, right? So we know the price is 1, and we know its book is 2, so we know its PB is 0.5. Now, when you're value investing, the golden PE would be about 1, maybe 2 at the max. So let's say 1 and then 2 at the max. So what we would want for a PB would be about 1, 2 at the max. And the reason why we want that, or below 1 would be preferable, is because now we know without a doubt, even just from a statistical analysis standpoint, we have a company that isn't currently being sold on the market for its current worth. So that's what I like to look at first mostly, just because it's such an impactful part of the company, and it's such an impactful part of understanding the financial side of the company. Now, I'm going to get into one more before I go, just because I don't want this to be too long. And I kind of want to do multiple parts on this and kind of expand on things. So I'm not going to go through every single one yet. But for the second one, I want to talk a little bit about finding a moat. And I drew this little castle. And essentially, let's say this castle, right? Let's say this castle is Tesla, right? Say it's Tesla here. Let's do a little bit bigger for Tesla. Give him some respect. So this is Tesla, and this moat is the thing that goes around Tesla that makes Tesla so strong, right? That makes Tesla so impossible to get to, because we have all of these other companies, over here that are all trying to basically attack Tesla and take away its market share. So what you want when you're finding a company is you want a company that has a good moat, so that you can understand that this company isn't going to just poof and get destroyed and get besieged by all sides, and now you're out of money, or now the stock price is completely plummeted, or their outlook is no longer as good, and now you're stuck in a misery of hoping that things will change, or they'll come up with some new brand idea. And so often, it's very difficult to be in those type of situations. So what gives Tesla this moat? What gives Tesla this water that makes it impossible for people to get to it? So we have a few ideas, right? We have a few ideas. We could say here, we could put innovation, right? So we could put innovation here. What else could we put? We could even put, you know what we could put? We could put Elon Musk. We can put environmental crisis. There. We could put I know I messed up that one. Autonomous. There we go. Autonomous driving. All right, and that's just to name a few. So let's see here. So we have the autonomous driving, we have innovation, we have Elon Musk, and we have an environmental crisis. And all of these things kind of, we also have a bunch of other things like SpaceX. We have, I'm actually going to put SpaceX down. SpaceX. And then we also have batteries. And the ability to make batteries is actually extremely important for cars, and to do them well and to make them affordable. Because making something affordable is really the first step to making it popular. So with all of these factors involved, we see Tesla has what we call a moat. It has something that's going to protect it from things that are coming to basically bite it in the butt. And things that are going to come around all sides and say, you know, we're here for your lunch money. And Tesla has a lot of really great things between Elon Musk, innovative ideas, autonomous driving, batteries, the environmental crisis, which will shift things away from oil and gas and more towards like renewable resources. And they have SpaceX, which is, you know, it believe it or not, it does impact Tesla stock. Just because of how closely related Tesla is with Elon Musk and Elon Musk is with SpaceX. And the prestige of SpaceX falls onto Tesla as well. So it's something that's very interesting. So these are things you want to be focused on. You want to be focused on what a moat is. And, you know, if you want to draw the thing out, you don't draw a thing out. If you can't come up with enough, then maybe the company doesn't have a great moat. You know, Tesla has an excellent moat, and that's why it goes up. Now, what Tesla doesn't have, in my opinion at least, is it doesn't have a great book value total equity. That's where I think Tesla sometimes ends up being a little bit difficult for me to want to buy, and sometimes I think it's a little stuck in a greed cycle. But, you know, Elon is doing incredible things, and there's nothing but good news coming out recently. So, you know, I'm very happy for him, and I'm happy for all of the investors who make a lot of money off of it. Definitely good luck. It's just something I just don't think I can get myself into right now, just because to me, it doesn't feel like a great value investment. Although, yes, I do think it might go up. I think I just want to see, the problem is now to me, this moat is good, but my problem is that a lot of these things, like innovation, right? This could go away. Elon Musk can die. Autonomous driving can become standard. Batteries can become standard. Environmental crisis will always be here, and SpaceX will always be here. So, that's the problem. And that's the issue right now, is that like a lot of the stuff that Tesla has going for it is in a position kind of, I don't know. It's just like eventually people, like you have NIO, you have the Apple car, you're going to have people who are going to come after your market share a little bit. And I think that to me, it's not that it's bad by any means. I don't want to even say anything about this company right now, because I honestly, I don't know. I just, there's a reason why I haven't invested, and it's mainly just because I just don't really love the fact that it just keeps going up on this constant crazy bull run. And sometimes it just feels like if one thing goes wrong, that company's just going to completely tank. And I don't like that. I really hate that with companies. That would be a time when I buy it, definitely. If I can buy Tesla down, that's the problem. I can't find a dip with Tesla. So it's difficult to find even a time to buy. which is really, really frustrating. But ultimately, it does have a great moat right now, so I understand why. And now you kind of have a better idea what moat means and what that means, and you'll see that all over the financial world. But that's basically going to be it for this episode. Like I said, I didn't want to go into everything. The next episode will go into basically knowing and understanding the industry and ownerships with integrity. However, I do think the first and the second one are super important. The third and the fourth and the fifth are also extremely important. But if you don't have a margin of safety, don't even bother. And if it doesn't have a moat, don't even bother. So, do these steps in order too as well. They're there in an order for a reason. So, thank you for stopping by. This is only part 1, so, get excited for part 2, 3, 4, 5. Really as much as I kind of have knowledge I want to like kind of put out there, and I'll continue making the series. So, just episode 1, and definitely it's Sunday today, so the January 10th. So it's the day before Monday, which will be a new TRXE trading week, which I will be covering on my videos. So definitely get excited for that as well. But with that being said, thank you very much. And I hope you have a wonderful rest of your day. And I hope that we can see a great week going forward. All right. Have a great rest of your day, guys. Have a good one.